Welcome to the Screencast. My name's Sukhjit Singh. Today we'll be talking about adjusting entries. Well, adjusting entries are made to update accounts and bring them to their correct balance at the end of the accounting period. If adjusting entries are not prepared, then some income, expense, asset, and liability accounts may not reflect the true values when reported in the financial statements. There are two bases for recording expenses and revenues. These include the cash basis and the accrual basis. Under the cash basis, revenues are recorded when cash is received and expenses are recorded when cash is paid. While under the accrual basis, revenues are recorded when they're earned and expenses are recorded when they're incurred. Thus, under the accrual basis of accounting, adjusting entries are made to ensure that revenues and expenses are properly recorded in accordance with the matching and revenue recognition principle. It is also important to note that because of the differences in timing, cash is never affected in adjusting entries. It is also important to note that adjusting entries almost always involve a balance sheet account, e.g. interest payable, prepaid insurance, and accounts receivable, and an income statement account, e.g. interest expense, insurance expense, and service revenue. There are four scenarios that illustrate the need for adjusting entries: deferred revenue, where cash is received before the service is provided; accrued revenue, where cash is paid after the service is provided; deferred expense, where cash is paid before the expense is incurred; and accrued expense, where cash is paid after the expense is incurred. For deferred revenue, the company has not yet provided the promised service and hence increase in liability. A service is provided each month, the liability account is adjusted down and the service revenue account is adjusted up. On the other hand, companies often complete the service and then bill the customer. This results in an increase in accounts receivable and service revenue accounts, as cash is received each month and cash receivable account is adjusted down and cash is adjusted up. Deferred expense occurs when a company pays for a resource before it uses it, hence increase in prepaid asset. As asset is used up each month, the asset account is adjusted down and the expense account is adjusted up. On the other hand, companies can incur the expense and pay for it later, e.g. salaries expense, hence increase in liability. As cash is paid each month, the salaries payable account is adjusted down. This is an example of accrued revenue, where the company completes the service and then bills the customer. The first step is to calculate how much the company has earned over the period and expecting as receivables. This is done by multiplying the hourly rate by the hours the service is provided. Then the following adjusting entries can be made. There would be an increase in audit service revenue and an increase in audit receivables of which the company expects to collect back for the service provided. Adjusting entries are also used to adjust for incorrect original entry. Here's an example. The original entry was recorded as an expense instead of the correct entry prepaid asset. This is because Sunny only occurs the expense as the insurance company provides the services each month. To calculate the 3 months incurred expense, we first calculate the monthly expense and then multiply by the number of months. After 3 months, the following entries are made to adjust for the original error when recording. There is still $18,000 remaining in prepaid insurance, and also the incurred expense is only $6,000, so we credit the expense by $18,000 to give the right balance. Thank you for watching, and good luck, my fellow accountants.
Created using Powtoon.